Good morning, good afternoon, good evening, yWhales, wherever in the world you are today. And most importantly, Happy New Year's. This is our first recording of 2023. And the year ended with a historic bang, and we've started right off with even more chaos. So today is January 5th, and it is just absolutely, I would say the news cycles have been chaotic for the last 3 weeks. Everything from, the Chicken Little, the sky is falling. We saw Solana take a hit of, even when they were down to pretty low. Just another like 30-40%, decrease, people calling for the chain that's going to die, but for no real reason other than the fact they just wanted to attribute it to Sam Bankman and some other things. And but more so, I think that there's just been a really big chill on the cryptocurrency markets. From that prospect, I still look around and see some amazing companies building amazing things on blockchain technologies. And I think it really speaks a lot to the fact that the unregulated side of Web3, of blockchain, is the one that's taking the big hits. That the thought and the theses that it's going to be kind of a globally non-compliance, free for all, is being reined in, and it's being really kind of, I'd say, predicated along the lines of the fact that so many consumers and retail traders are having rugs just swept out from underneath them of no fault of their own, just because they chose the wrong people to manage their cryptocurrencies and everything else. So that's why it's so amazing to have my guest here today, Sidney Powell with Maple Finance. And Sidney, you have a really storied background both in TradFi as well as DeFi. So I'd love if you don't mind take a second and just kind of walk us through that background. And then I really am excited to kind of talk about Maple today.
Yeah, for sure. And very happy to be here. So my background begins a few years back in traditional finance and in banking. So I used to work in the banking sector in Australia. I was at one of the commercial banks called NAB. And in the banking sector, I was doing securitization, which really it sounds like a big word, but really what it means is helping lending companies to borrow so that they so that they can create loans, and those could be loans for homes, for cars, for credit cards, personal loans. It's pretty varied, but securitization just refers to the technology that we used. So I was working on that. That was actually where I first started hearing about cryptocurrency and blockchain. And what I was interested in, coming from that background, which is where you're dealing with layers of debt that have a lot of conditions associated with them. So what I was interested in when I started learning about smart contracts was a lot of what we were doing in banking was a set of if-then statements. And so when I started learning about smart contracts and the concept that you could program money to go certain ways in response to certain triggers being hit, that sounded exactly like what I was already familiar with doing in banking. And so I kept tabs on it. I ended up leaving banking to go and actually work at one of the companies that would have been a client of ours. So that meant going and seeing how the sausage was made at a lending company, so to speak. And so we had to then borrow from banks, from debt markets, in order to create loans ourselves. And so that introduced me to how difficult it is to actually do that in traditional finance. And so that's when I started thinking more realistically about actually using the technology of smart contracts to, create capital markets on top of the blockchain. And so that was then what prompted me and my co-founder, who I used to work with in the finance sector, to create Maple. And so the vision with Maple hasn't necessarily been it hasn't necessarily been that lending should be restricted to crypto or to the blockchain sector. It's that this is a new technology that is going to eventually encompass all of capital markets, and that they will move on chain as a bit of a secular trend, just because of how good the technology is at managing debt and lending.
That's fabulous. And I love the fact that, again, that it was a piece of technology, an EVM compatible chain. Sometimes Bitcoin is what brings you guys in. And I'm sure that you've read the white paper and kind of got endowed with it. But that was the same thing for me. I thought Bitcoin was interesting. I bought a bunch of them in early 2010. They don't exist anymore because I what, I can't claim OG status because I didn't believe long term, and I would have
Yeah.
sold them, when they hit $20 a piece. To be clear, but the what really became interesting was when I started seeing kind of smart contracts, and
Hmm.
coming from a big data world of exactly what you're saying, these archaic ERP machines, Oracle and AS400s and all this garbage that we were running since the 80s, and suddenly you go, you know what? Those people that really understand what the immutable part of blockchain can do, as well as the fact that the smart contracts are written, agreed to, and exist on chain, it's a huge difference. But it requires, and you can't just tweak your mind. You have to kind of come over here and come about it from an entirely different section. So I love hearing that people like yourself, like you got it, you understand it, and now you've built some amazing things.
And it's interesting because I think a lot of people will say, well, all the things you can do with with smart contracts you can do in traditional finance, and it's also true that 200 years ago you could send a letter from the US to England. It would just take longer to get there, and it's more or less a similar concept that when you're doing things at tremendous amount of volumes, speed and automation matter. And what actually tickled me with smart contracts was I think the value is best illustrated when you start to think of it at immense scales of volume or complexity. And so when I was working in securitization, you might have a structure that could at a stretch have 6 or 7 tranches of debt. And when I say tranches, I mean think of like layers of a pancake, which is kind of where the name Maple ended up coming from, was the debt stack versus layers of a pancake. But with smart contracts, it was possible to envisage a transaction or a debt issuance where you might actually have 1,000 different tranches because there's no marginal cost to tranching and having 999 different layers of debt. Whereas in the real world, doing this all in paper, there is a cost to going, more than 5 or 6 tranches. And so that was how I started to think about it. Was like, what if you could automate this so that you could have, 10 times what we could have done before, or 100 times what we could have done before in terms of scale and complexity when we were doing all of this manually or in spreadsheets. And it's not necessarily that you're going to actually get to that level of complexity, but that it's that thought experiment that really highlighted just how much better this technology is.
Yeah, and one of the things I like to talk about is that I don't believe that blockchain and all this stuff is really designed for humans. All of the things
Mm,
that you're building and what we're doing is, as we look into that long future of AI and a lot of more high powered computer programs, you have to have something like blockchain, smart contracts, and everything you're building for them to actually be
mm,
able to do their job. Because we can sit around and create as much natural language learning as we possibly want, but at the end of the
mm,
day, feeding it an AI, 10,000 pages of documents and saying, figure it out is very different
mm.
than when you input it saying, this is what I want you to do. And tell me if something is violated or improper and give me the solutions on
Yes.
how to fix it. And so exactly as you're speaking about the speed and the reliability and the redundancy are all secondary to the transparency. If I throw around every single
Yes.
buzzword I can come up with, because that's the
Yeah.
biggest thing. Why did Enron and so many of these other people fail? And if we take Enron and we take FTX, and I'm so sorry about all this, but if we take Enron and FTX, it took months to understand what was
Mm,
really wrong with Enron and have them fail, very ungracefully from there. And it caused a massive reaction because people didn't know for so long. From the
mhm.
time that we understood that there was something wrong with FTX till it got to bankruptcy was literally days. And I think
Yes.
that really showcases not the success of this, but it showcases the power of where we're going. Is that before something gets too big and before something gets totally out of control, we
Mhm,
need to have these safeguards in place and make sure that they're built appropriately.
mhm. Yeah, I 100% agree. And I think a lot, what we've watched over the last couple of months since November's implosion of FTX uh, has been a bit of a collapse in CeFi and in centralized finance. And uh, I think the future lies in a bit more of a hybrid and the use of this on-chain technology. So we talk a lot at Maple about on-chain capital markets, but the fact is, if you look at some of the problems that have occurred at CeFi lenders, so taking the Gemini Genesis case as an example, what you had was the replacement of a non-performing loan with a new loan that was longer dated, but none of that was visible to any of the people who were, the liability holders and the depositors who were financing that. Whereas having loans done on chain, you're going to immediately see anything like that happens, and so you can always see a lot see the performance in real time of a loan portfolio. You can see the first loss capital of the reserves backing it, and you also have self custody of your funds, which means you can avoid them being commingled. I think commingling is really one of the root issues that is sort of behind a lot of the CeFi collapses. It's that you have a lending operation, a trading operation. You might have a loss in one of those parts of the business, but it bleeds over into the other part.
Yeah, and one thing I would love to hear your thoughts on is I feel like we've just made it too fast.
Yeah.
We've kind of taken, if you go in TradFi, from the time someone says, "Hey, I would like to invest in ABC," to actually
Mm.
being able to invest in ABC, there's a lot of safeguards. There's a lot of compliance. There's a lot of government agencies and regulation and security that, a lot of people think regulation is a horrible thing. It's there. A lot of it's there because like people stole. There was a fraud. There was cheating. There was everything else. And so I feel like what we did is we took, this thing where it's like, hey, I want to invest, and down to this, like we've eliminated every safeguard. It's almost all gone. And consumers, let's be clear,
Mm.
if everyone was okay with self custody, banks would not exist. But banks exist because people don't want to be responsible for it. They want to walk in and say, here's my driver's license, here's my person, I want to open an account. And if they don't, and if for some reason they lose their checkbook, they don't want to say, well, I don't have money anymore. Or somebody stole a check. They want those safeguards in place. And so I really feel like the next iteration we're going to see is very much based on what you guys and how Maple and whatnot does, which is you're bridging TradFi and DeFi and kind of grabbing the best of both worlds.
Mm. It is an interesting question there, but I do wonder, because the common consensus is that self custody won't happen in future because we're all already so comfortable with banks. But the alternative to having your money at a bank was to have a large sack of cash, which meant you, one, couldn't take it around everywhere because it's a security risk,
Yeah.
but two, you couldn't send it overseas. And so digital money was an evolution of a bank account. The bank account came first, and then digital money, being able to send it, from Australia to the US, came after that. But now, where you have digital money and the ability to self custody, it is going to be interesting to see whether some people don't actually opt to go back to that, like where you have a private vault, but then you have your own hot wallet that you use for transactions. It will be interesting to see. I actually don't know which way it'll go. Hopefully, we can hedge our bets.
Yeah, I mean, I am all in on DeFi, and I firmly believe in anything and everything that's there. And I don't mean this a knock to my friends at Ledger, but this is a terrible solution. This is the equivalent of the 14K modem. Like, I understand it's necessary, it's the best thing we have today, but we did not, the web did not evolve because of 14K modems. It evolved to the point where, again, there's a lot of things you could do. And I feel like this is a holdback because I've seen so many failures of this, not the device, but of the protocol. When you've got people and you do this, you see some incredibly, competent people that are at a conference and they're traveled, they're away from home. We so happened to be at a conference the week that the Terra Luna was melting down. And I can tell you, I had hundreds of panicked friends that had their ledgers and all their money safe and sound in a vault back home, totally unable to access. And so it really does break a few things. But you see this every day too.
Yeah, no, 100%. And I was, going to share not a horror story of my own, but I did know somebody who actually had the seed phrase to their ledger was captured in a photo when it was written on their desk, and then their iCloud got hacked, and somebody found the picture, grabbed the seed phrase, took their funds. So there are
it happens to the best of us.
Just agreeing that self custody is difficult, but I think interesting solutions like NPCs and things are quite interesting. But I think ultimately, hopefully, the market can provide a solution that people like. That's why there are entrepreneurs.
Yeah, so let's talk a little bit about because
Mm,
Maple, like I said, you guys have been in the news for some amazing
mm,
things lately, but also you've been kind of caught in a little bit of collateral damage over this last kind of cycle.
mhm,
Talk about some of the challenges it's been where like your business and theses is valid. You're taking care of your clients' funds and you're appropriately managing loans based
mhm,
on current normal regulations. What's it
mhm.
like getting caught kind of in the crosswinds of these things?
Yeah, so I think with with Maple, we found early product market fit with pools that would lend to one type of sector. So market makers, market neutral funds, and that was because they had the largest capital needs in crypto. They weren't readily served by lenders outside of crypto, and uh, in terms of their operations, they could grok using a stablecoin, and so it kind of ticked three boxes. And then what we saw was uh, contagion risk following June and July with Celsius and 3AC. The loan book actually weathered remarkably well through that. It only had one $10 million default on 960 million in loans outstanding at the time. So um, as we got through that, we also managed to avoid Alameda pretty well. So there were a few pools that had a couple of hundred million in loans outstanding at the time, and they had unwound any exposure to Alameda. But then after FTX, they got caught with two borrowers. So uh, one was distressed, but is actually in pretty constructive restructuring conversations at the moment. And then the other one, orthogonal, um, was had assets held on FTX and defaulted as a result of that. And so that caught the protocol as well as two pools that had been borrowing from in the crosshairs. And so I raised this issue of Maple is trying to position itself as infrastructure. So we ultimately didn't want to be the lenders ourselves. We wanted to create a platform on which people could run a lending business. And that lending business takes the form of a pool. So we had Maven 11 Credit was one of the delegates who would perform the underwriting. And what we saw as orthogonal defaulted was that people grouped the two together. So the the decision maker approving the loans with the platform on which the loans were originated. And so it has been a challenge separating the two and saying, well, Maple's technology continues to perform and to process both loan repayments and withdrawals, and also that we released version 2, which also addresses some of the pain points that had existed around June and July. And so anyway, all that is to say that there were challenges, and part of what that has prompted us to do now is to really emphasize, as we look in 2023, diversity. So it is going to be a push into real world asset lending, so diverse lending opportunities, and a renewed focus on diversifying the number of delegates on the platform, because we want strong, reputable delegates on the platform, but we don't want to be systemically exposed by having like one delegate who's 90% of all the outstanding loans. And so that's really come into focus for us for 2023, as well as one third limb, which is continuing to upgrade our technology so that we give delegates the best tools. We don't want to change tack and become a lender ourselves. So it's giving delegates tools to manage liquidity. We've done that with version 2, giving lenders a diverse set of delegates to choose from and real world asset lending opportunities. And so some of those, which I can talk about if it's going to be of interest to the audience, are
Absolutely.
things like reinsurance.
Yep.
And so, this is something that's very commonly funded in traditional finance. Trade receivables pools, which would be effectively extending a loan that is collateralized by a bunch of real world loans that are smaller in size, and again, very common in securitization in traditional markets. And the other one that we're really excited about is bringing Treasury yield on chain.
Mm.
And that's because what we've noticed is that there's a gap in cash management and a gap in access to low risk yields on chain. And so you have a lot of capital that remains on chain, remains in stablecoins, because uh, despite the space advancing, it's not very porous between on-chain capital and off-chain capital. And so what we're trying to do is offer a lower risk yield and way to manage cash. So if you're a yield fund or a Dow Treasury, you can complete KYC, and you will need to complete KYC to access it. But you can therefore get access to a low risk yield that beats the kind of the 1% that you might get on Aave or Compound, where you're sort of also having to take smart contract risk that is very difficult to price or quantify for yourself.
You know what I really appreciate about everything you just said is you're not trying to reinvent the wheel. You're taking
Mm,
existing markets, you're taking very, institutional products that are existed, researched, trillions of dollars in size, and you're quite simply saying, let us help you make these better to manage in a
mhm,
variety of complexes. And I like that because I've talked to so many people, then they're like, yeah, if you've got your board ape, you can loan on it, and you can do this, and you can do all these crazy things. And let's be clear, I love
yeah,
the degens. Like I love the degens. I
yeah,
love what they build, and this space would not be the same without them. And so I
mm,
will always encourage, and I will continue to purchase all the random coins and NFTs I do, because I want to play along. I want to understand
yeah,
where that market goes. But when we're talking about like how do we get from, like the cryptocurrency market went from, kind of a couple hundred
mm,
billion to $3 trillion and has come crashing down. Olympus
mhm,
Dow went from, a couple $1 million to $3.4 billion and then came crashing down. And I think that that's
mhm,
really indicative of the space and the fact that we're trying to do too much. And so,
mhm,
what I'd love to hear just a little bit more expansion on is exactly that thesis, Sidney, which is where we're not trying to reinvent the wheel. We just want to give
mhm,
a better playground for the institutions to play in.
mhm. 100%. Uh, the way that I describe Maple, I often use this metaphor of Shopify, which is that what they did was they took a bunch of different services that you needed to do if you wanted to set up an online e-commerce retailer, and they just turned it into a bundled product that you could use. So payment processing, listing inventory, uh, drop ship fulfillment. And so what we've tried to do with Maple is we're absolutely not saying that you can manage credit risk better on chain. That's not the thesis here. The thesis is that if you can connect sending money with software conditions, then you have an innate advantage. That for me is the advantage of this technology over the conventional tech stack in traditional finance credit funds, which is an Excel spreadsheet and logging into a bank account, and then maybe you occasionally pull a CSV digest, and then you match it up with some VLOOKUPs in Excel. Uh, it's instead saying that you know any payment that occurs on chain in a lending business, you can verify, you can see it in real time, you can instantly pull reporting, and you can have reports that run in the background all the time that allow you to provide reporting to depositors. It also allows you to set trigger conditions, whether it's to recall a loan if a payment is not met immediately, or to liquidate collateral, and then as well to remit payments back to depositors. That was a bit of a jumbled description, but what it is to say is that what we are trying to do with Maple and this thesis is that we can eliminate a lot of the back and middle office functions of a lending business and make them significantly lower cost, so that apples to apples, somebody who is using this technology will have a lower cost base. They will be able to operate a similar scale lending business with a much lower footprint in terms of personnel and time. And they'll be able to do that because we've provided a bundled set of software which combines reporting, loan origination, depositor management, um, and reporting all together in a bundled service where they're not investing a fixed cost in using it. Instead, it's all a variable cost. Same way that prior to Amazon, you used to have to pay for expensive server racks. And then
Mm-hmm.
following AWS, you could simply spool up the amount that you needed, and then it was just a variable cost of your business. My thesis and Maple's thesis overall is that we've actually seen uh, we've seen debt markets contract relative to equity. So if you look back 200 years ago, the great companies of the 1800s, so Standard Oil, Carnegie Steel, or U.S. Steel, they were actually significantly funded in a large part by debt. And what that
Mm-hmm.
meant was that they, as those businesses grew, were forced to watch costs. They were forced to prioritize only new investments which were going to be profitable. And then as we got to the latter half of the 20th century, we saw more of a reliance on equity and venture capital, which meant that people focused less on cost and they were willing to make a larger number of bets in the name of growth. I think what we're going to see over the next 10 to 20 years is more of a focus and emphasis on the use of debt by profitable businesses. And so we want to provide a platform that caters to that. And I don't think it's going to be provided by banks. I think it will actually be provided. The micro trend is that it's going to be provided by credit funds and alternative lenders. And so we're trying to provide a product that caters to the macro trend, more debt, good debt, and the trend within that, which is that the people who are going to be using it are going to be new credit funds and alternative lenders. And we're just trying to give them the tool set to do so.
And I think the thing that really you didn't speak of is the fact that there are so many people around the world that have zero access to credit facilities like this. And so, like, if you're in New York City, like, it's great that you can use this or you may be interested in this, but you have a gazillion choices. You can walk a block and have 20 different banks, and do anything you want to do and open an account, close an account, everything you want to do. But depending on where you live in the world, you can have a perfect credit score. You can have all the money, in your little bank account, but you don't have access to products like what you're talking about. And if you want to launch a company, you need access to debt service and financing.
Yes, 100%. So there's a real cost to building banking infrastructure. And what I see and what really excites me about, Ethereum and smart contracts is that it makes banking infrastructure, like the basics of banking infrastructure, so send a payment from point A to point B, accessible globally. And so our thesis is that you can build a number of very profitable businesses and protocols on top of that, because that is therefore, it's like a new layer of infrastructure similar to the electrical grid or the interstate highway system. And we're just building an application that then adds value on top of that. And so, as you said, if you are in some of these regions, accessing finance and lending is not possible. And it's not because you're a poor credit. It's just because the infrastructure isn't there to reach you. Sending money, there is a cost to sending money from point A to point B. That's why Visa is a multi-deca-billion-dollar market cap company, and that service is table stakes on Ethereum and in a lot of these new smart contract platforms. It's just a bundled feature of the bundled feature of the platform, similar to what Internet Explorer was in in Windows 95.
Yeah, and mainstream, I think that's always the goal. I mean, right now, even with this last bull run, there was no one saying, we're mainstream today. We had mainstream interest, but not mainstream adoption.
Yes.
And I really, looking out to the future, I've read, quite a bit about Maple, and just as full disclosure, I haven't used Maple. I haven't invested. I don't own any coins or anything like that. But I really spend a lot of time looking at those companies like yours that say, like, the regulations exist. Let's start with those as the rules for the entire game, and let's see how we can expand on this and be more inclusive. And so the thing I really like about the way you guys are coming at this and the way this conversation is going is that this is just kind of your foothold. You went from V1 to V2. You learned your lessons, and to be clear, you're still on Zoom with me. We're still here having this conversation, because I can tell you over the last quarter, there was a lot of people that we had scheduled for the podcast. You can guess the names of the companies that they canceled because they no longer exist. And so, I think it really showcases that following these rules and regulations, and you guys saying we don't want to be a lender, we want to be a facility for lenders, and holding true to that, because, let's just say DCG started with a very different thesis than where they ended up. And they did that because they felt like, well, no one else is willing to do this, so we'll do it ourselves. And, it's a little chaotic world right now that anyone that uses those platforms is living with.
Yes. Yeah, 100%. And, we remain as focused as ever. I think, the important thing is, the Wright brothers didn't launch a Boeing 747 at Kitty Hawk, right? Like, you have to build and improve it as you go. And any new technology needs to be stress tested and battle tested to grow. Crypto is not set up to handle, $10 trillion of economic value at the moment. But the point is that it grows, and we learn from stress test scenarios like what we saw in June and May with Terra, June with 3AC and Celsius, and November with FTX, so that we then put appropriate mitigants in place for future, and then we get a little bit larger, and then we go through another stress test, we learn, we then get a little bit larger. But it's a march of progress. You have to stay committed. You have to be willing to kind of take the painful times.
Yeah, and there's some people that their thesis was entirely invalidated during this last bull.
Mm,
They believed just because it's on blockchain and I sprinkle a little pixie dust on it,
mm,
the value is going to go up forever. And the reality is no, it's just as susceptible as traditional markets. Digital scarcity is
mm,
not as important to some people as everyone thought when it comes to real world issues of can I
mm.
feed my family, can I pay my mortgage, and other things. And so very quickly those PFP projects went away. I'd love to hear your thoughts around, because you guys are on Ethereum and Solana, and I'd just
Yeah.
love to hear your thoughts about blockchain technology overall. Some of the bigger pain points that the developers and the communities that we speak to really should put a little bit more time and energy into focusing. My personal two is wallets, bridges, and oracles
Hmm.
need a lot of work. Bridges, in fact, I think are horrible today. But I'd love to hear your
Yeah.
thoughts and a little bit of why.
Yeah. So I think wallets, bridges, and oracles are very good examples. The two that have stood out most to us in our position as a lending platform and protocol have been uh, wallets. So, but specifically MPC. So when we deal with institutions who are handling hundreds of millions of dollars and they want to deploy that, uh, they do so through an MPC wallet because they need to put policies and guardrails in place so that they don't have somebody who controls a key and sends it off to a wallet in Tahiti or Bermuda. And so
Or
that was
Seychelles.
number one. Yeah, or Seychelles. And so that was number one. And then the other one was on and off ramps. So, tangential to wallets. But if Maple's vision is to be capital markets infrastructure, not just for crypto companies, but for any innovative companies. And so if I go to a SaaS business that doesn't touch crypto regularly and say, you could take out a loan in USDC, the first thing they say is, well, how am I going to pay payroll in USDC? Now we do a bit of that, uh, but it's definitely not mainstream business practice. And so what we need is more adoption of on and off ramps. And so I was overjoyed when I saw that Apple is accepting USDC settlements, because it means, if you have a digital version of the US dollar that's much easier to use, I think naturally usage is going to proliferate. And so I think that will, a few years from now, be the mainstay. Uh, but what it does is, if a company can accept revenues from its customers in USDC, then they can also borrow and make interest payments in USDC. And so that's a huge enabler for us in terms of adoption. And so applying that back to the other question you mentioned, which was, how do we think about blockchain technology in terms of layer ones? If I were a new project today, I would pay the most attention to the building blocks that I then need in across my workflow to reach my customers. So, as I said, we needed MPC wallets. We also need on and off ramps to be able to reach a wide number of customers. So if there were a fantastic new L1 blockchain that was super fast,
Hmm.
and had all the other bells and whistles, but they did not have that infrastructure, which was one of the challenges we faced when we first went onto Solana. Uh, that's something I would think really hard about in terms of making that decision. And so, yeah, so it's kind of boring, but I would encourage anyone who's building a new project to think of the infrastructure that will support their product.
Yeah, and I really love that. And just as a quick note, I don't think I've talked about it much. The original theses and why yWhales got started, over 2 years ago, was a very simple question: how do you get eight
Hmm.
figures into cryptocurrencies? And
Yeah, right.
and and you tell me how hard that is to do.
Yeah, it's incredibly hard, because as soon as you transfer any money, you get instant questions about having to prove the source of funds, and then good luck telling people that you took a venture investment from crypto venture funds, or that the source of funds is crypto. It's easier today, certainly, than it was previously, but it still remains tremendously difficult.
Yeah, and if we're sitting here saying the world is going to digitize and everything's going to go
Mm,
into blockchain, and we're not saying which blockchain, you're talking hundreds and hundreds of trillions of dollars, and we just saw a
mm,
failure when we hit 3 trillion because people were like, oh, let's run, or
yeah,
they kind of did too many weird things with leverage and all sorts of
yeah.
stuff, and too fast and too quick.
Yeah, but that is one of the reasons we're trying to bring treasury or low risk yields on chain, so that people, because that barrier between you know fiat and crypto or stable coins is still not porous enough yet. So a lot of people are incurring huge cost or slippage going between the two. And so the thesis with that pool idea is, if we can operationalize it and put in place great operational risk controls that other people can't afford to do themselves, and then have the brokerage and the banking relationships so that you can send $50 million in and out easily with low cost, then would people want to keep their funds on chain, or be encouraged to keep more funds on chain? I hope so. I mean, we're building it so that we could use it ourselves.
Yeah, and I think that the biggest consumers that are users of DeFi that desperately want DeFi to work and they want it to be right
Mm,
is TradFi. I think that if
yes.
if there was a product out there that everyone from Bank of America to I know we know Fidelity's doing a little bit, but let's be clear,
Hmm.
they're scratching the surface and testing things. But if there was a
Hmm.
product that existed that the custody was safe, transparency was there, the KYC and AML and all the regulations kind of fit in, as well as those smart contracts were validated, verified, you're going to see TradFi, the big institutions being the largest consumer of that product, and retailers will get the benefit of it. But right now, it's being
Hmm.
led by retail, and they're trying to force TradFi to come back over kicking and screaming when they know it doesn't work.
Yeah, yeah, 100%. I think you kind of alluded to before that, like, regulation is going to be here. And one of the trends I have seen emerging is you have these kind of two tracks of DeFi. You have the degen DeFi, and then you now have more options in what you'd call institutional or permissioned DeFi, where you have KYC policies applied. You have gating, and you have you have it catering to institutions who want to know who else is in the pool that they're in, and that KYC has been completed. And I think that's good for the space, because the more volumes we have
Yeah.
insurance is not going to be provided by self-insuring retail users. Instead, you need that kind of balance sheet heft to provide insurance to come from institutions, and we need those core building blocks like insurance, lending, and borrowing, in order for this space to really evolve. Everything else builds out from those primitives.
Yeah, it it really is. Um, when you look at where the roadmap can go for blockchain, it's
Mm,
going to look a little boring when you look at it through an institution's eyes. But
yeah.
that doesn't mean that all of blockchain and all of Web3 has to be boring. But we have to have that core fundamental. Like, let's
Mm,
just focus exactly as you're talking about with these real world assets and what you're doing. Let's just focus on just getting to these assets to sit as stable on blockchain as they do in a paper vault at a bank. And if we can
mm,
make them feel that secure over a 3 to 5 year period, then you're going to see the bitcoins, hitting
yeah.
the hundreds of
Yeah.
thousands of dollars.
Well, put it just to riff on that. I mean, one of the ideas we're kind of excited about is, could you have insurance, similar to FDIC, but for exchange accounts? So
Mm-hmm.
small retail could potentially have an exchange account insured for up to, I don't know, small amount, but enough to cover most retail users, like 10K or
Yeah,
20K or something. That's a boring product. That's insurance. But doing that and providing that and finding a way to craft that product and offer it within the space will make your average retail user that much more comfortable, that they're not going to get scammed, that they're not going to get rugged. And it promotes best practice and transparency at the exchange that needs to qualify for that insurance policy, because then they have to go through DD, or else they won't get underwritten. And so I think that just promotes better practices, and it also makes it safer, and therefore safer for retail, and therefore retail people will be more willing to participate. But ostensibly it is a boring product, insurance.
boring is fine. Boring it
Yeah.
it doesn't have to be a
If
thrill ride. During a bull, I get we
yeah.
all love it, but this is
Mm.
the flip side of it.
Yeah, I was gonna say I wouldn't be unhappy if 2023 was a little bit more boring than 2022 was.
Yeah, I'll throw my New Year's prediction out here, and that is we will see. Of course, there's going to be another bull, and shockingly, it's going to be tied to the Bitcoin halving. But
Mm.
in between now and then, you're going to see a very different Web3 blockchain infrastructure world that is very much more looks and acts and sounds a lot more like traditional banks around the world than it does
Hmm.
the Terra Luna stablecoin chaotic nightmares and the Genesis and kind of random APIs that they do.
Yeah, yeah. I uh, I tend
What's
to agree.
what's
I
your
think you'll
what's your
see.
predictions? Let's hear them. Come on, I gave mine.
I, I was going to say, so I think people will shift more back towards debt than venture equity overall. So I think that'll be kind of a macro trend. But I think what you'll see is actually the fact that there is a lack of great risk-adjusted yields on chain will actually prompt more tradfi institutions to start to come into this space because they'll see that they could potentially borrow or source capital at 1 or 2% less than what they can in traditional markets. That bringing institutions in will start to promote more adoption. Um, and it's something that wasn't possible 12 or 24 months ago because TradFi yields are so much lower than DeFi yields or on-chain yields. So I think those are a couple of predictions. Um, and and I think the other one would actually be like if we could see something like an exchange insured account, then it would be bullish for more retail adoption as well.
Love it, love it. So Sydney, as we kind of wrap this thing to the close, any other thoughts just for anyone? A little bit about Maple. I know you got a great roadmap going on. Where can they find you? And then just kind of for entrepreneurs in the space, any thoughts about people that want to enter into and build inside of a blockchain or Web3 business? Any thoughts of just kind of here's the
Mm.
mindset to be in?
Yeah, for sure. Uh, so I think we just released V2, and then now our focus for 2023 is on more diverse lending opportunities, bringing on more reputable delegates. So a core thesis is really that we're going to build capital markets infrastructure so that reputable delegates can run innovative lending strategies which are going to be available to institutions on chain. And so that means more diverse pools, real world assets, more delegates on the platform, and then continuing to try and build tools. So we're going to try and build an SDK, active collateral management, which would be with like a regulated custodian. But anyway, more of those tools for institutions. Where can people find out more about us? So maple.finance, we're at Maple Finance on Twitter, which is probably the best place to hit us up for announcements. And we try and do a monthly community call as well. What advice would I give to a new entrepreneur kind of entering the space? I think uh, there's certainly a lot of critiques of the space, but it's still we are still very early, and this is a great time to get in. I think that what an entrepreneur should think of when they try and enter the space is don't necessarily think of like a push factor, like I want to build a derivative on chain or some other just funky technology. Instead, try and think of a pull factor. Like what is something they want to see that is not being served at the moment? Because ultimately, I think those are the sources of the best ideas and the ones where you'll actually have an edge. A lot of people during bull market times were pushing it was I have an idea for a new technology and there was plenty of abundant funding. Now, an idea needs to have a viable path to be natively profitable very early on in the current environment. And so I'd say focus on the pull factors. Don't get despondent. Remain positive. I think a couple of books I enjoyed reading over 2022 as the volatility were happening were like Man's Search for Meaning, um, uh, letters from a stoic and some of the more philosophical stuff to just kind of put things in perspective. So um, Yeah, that's my advice to anyone
I
new.
love it. I love it. yWhales, this is Sidney Powell with Maple Finance. I absolutely encourage you just to check out their projects, their products. You guys do a great job on kind of not blogging's an old world, but you guys put out a lot of content talking about the industry from a very interesting perspective. So I thank you so much for your time, and looking forward to connecting here in the near future. yWhales, that's Maple Finance, Sidney Powell. See you soon.
Perfect. Thanks for having me.